Good Saturday morning to you, everybody, and welcome to Mortgage Matters Radio Show with Rob Weinberg. I'm Gary Byron. Rob, hey, how are you? Good morning.
Good morning.
How are you?
Doing well.
How was your week?
Busy, crazy.
Good. You know, you got one show in the bag. We did our pilot last week. I got to tell you, I mean, you're the talk. A lot of people have tuned in, contacted. I would talk to some people just being out and about. Somebody even contacted, I think, the radio station and said, you know, that was a great show. It's very informative, and you brought up things that a lot of people didn't know. So, what I'd like to do is maybe kind of pick up from where we left off a little bit. Before I do that, though, I did have a question that I just ran out of time last week that I really wanted to ask you. And I guess it's kind of maybe more of a personal question, if you don't mind. How did you get into the mortgage industry?
Yeah, pretty crazy story. I think everyone has a story about how they got into their career. But so I was an entrepreneur from a young age, always looking for ways to make money and just kind of take control of my future a bit financially. So I was at the age of 18, maybe even a little bit before 18, I was involved in some direct sales, multi-level marketing, network marketing, because you have to just be 18. There's not really a lot of...
You mean like Primerica kind of stuff?
Not necessarily that company, but, that model where you're selling products and recruiting others.
Multi-level marketing.
Right. So, I think the industry as a whole, the correct term is direct sales.
Okay.
So I got involved in a direct sales company, in my 17, 18-year age. And while I was in that company, I did really well. I had kind of a knack for talking to people. I had some enthusiasm there. People wanted to speak with me. And, I was able to create a little bit of a residual income just in a couple of very focused months of working with this direct sales company. I got some recognition and I was able to network and meet a good amount of people. And one of the people that I met there, because I was so young, most of the people were in their 30s, 40s, 50s. Well, I at the time I remember being there at 18 years old and nobody else was in my age bracket. Through someone that I knew at that conference, I was introduced to now a friend of mine, and he was closer to my age group. So he was like in his mid-20s, okay? When you're 18 and everyone else is 35, 40, someone in your mid-20s you gravitate to.
Yeah.
So we just immediately became fast friends, hung out a little bit, did a little bit of partying, and just really became friends. And we both were doing pretty well with this company, but this was literally right when I was starting college. So I took the eye off the ball, so to speak, and I didn't really pursue that anymore. I had a little bit of income coming in, but my priority switched to school. It switched to my education. I knew that was going to be important. I was going to study business and entrepreneurship and finance and all the stuff I was interested in. And, Florida State University, that's where I went.
Nice.
Go Noles. So anyways, I took the eye off the prize or off the ball with that direct sales, but I kept in touch with my buddy, okay? And he got in touch with me like 3-4 months into, college, and we were talking, and he's like, "Hey, I'm in Hawaii right now." I'm like, "Whoa, wait a second. A couple months ago, you were struggling financially. You're in Hawaii right now?" He's like, "Yeah, I got into the mortgage industry, and I'm a sales manager now, and I've made." It was an ungodly amount of money. It was
at a young age.
He had made a 6-figure income in a few months. Okay. And I had no interest in mortgages, really. I just knew, again, necessary evil. No one wants one. Stuff had been passed down to me, and I had heard my parents talking and other people talking about mortgages. You don't want one. So I wasn't interested. But when he was telling me about that sort of financial windfall, and this is like in 2003, 2004, and I'm like, oh, wow, okay, maybe I need to look at this as a potential option. If he can make that, then I surely can make a 6-figure income in a year. So he ended up starting a mortgage company. He said, "Hey, when I get back from Hawaii, I'm starting my own company. I need good people. I'll be in touch with you." And he ended up hiring me on, to help out like a junior loan officer at that point. The licensing was very different than it is today. Was not as strict. So I was able to start helping with some loan processing, with some loan applications, just kind of dipping my toe in the water with the mortgage industry. And I took to it, and I was able to, help people. I liked it. There was, a challenge about it.
Well,
it was
you're a
something
numbers
new.
guy. You like numbers, right?
I was really bad at math as a kid, but I like the finance part of numbers. I like the money part. So I was working with him. I was doing well. And he told me, he said, let's give this about 90 days to see if you do well. And if you do well, I'm going to fly you out to Chicago. That's where he was based. And he said, I'm going to teach you how to make the real money in the mortgage business, which is the sales part, okay? Where you actually get clients and push a loan through from start to finish. So that's what ended up happening. I did well. I flew to Chicago. I did about 2 weeks of training there with him and his wife in their office. I got a couple deals up, on the board, so to speak. And I loved it. And I really I enjoyed the flexibility. I enjoyed helping people. I liked the numbers. The money was good. Mm-hmm. Again, very different than today. You were compensated differently back then than now. You cannot make that type of money today in the mortgage industry. There's a lot of regulation stopping people from being taken advantage of.
Sure.
And stopping people from, that sort of thing. But, I took that, I ran with it, and I did mortgages part-time while I was in college. Okay, so I was going to school during the day, and then I would carve out some time in the morning and in the evening to do my mortgage calls and work with clients and get loans through. So that was about 3 or 4 years. After that, when I graduated from college, I said, this is what I want to do. Nice. I know I've got other stuff going on that I could do. There's other businesses, but I'm doing well with this. I want to stay with this. So at that point, I went and I looked out and sought out, what's my next step? How do I move forward?
Listen, you've got an incredible background, an incredible history. Maybe you can tell me what some of the differences are between a local mortgage advisor versus like maybe one of those online or those quote unquote, big box type of lenders.
Yeah, so it's a huge difference. So most people, when they think about a mortgage, they want to go to the local bank or they want to go to some local, financial institution and go in there and say, hey, I want a mortgage. And again, that was probably passed down by their parents, grandparents, or other people, right?
Right.
And hey, back in the 80s or 90s, maybe that was the best option, but you really need to deal with someone that's got the financial background. That's not just an order taker, okay? When you go into a bank or financial institution and say, hey, I want a 30-year mortgage and I want 2.5%, 3%, whatever the number you give them, and then they come back and they say, okay, here's what we're going to give you and here's what you asked for. That's an order taker. There's no advice there. There's no, strategy there. And it's really important that you deal with a local mortgage advisor because a mortgage advisor can look at your overall financial picture, not just the mortgage, but your retirement, your savings, other real estate, other investments, other things, and actually intertwine that mortgage into it. And, debt consolidation is a huge piece. Other debt that you have outside of the mortgage, how can that be intertwined? And you talked about online lenders. So these online lenders are the epitome of order takers. They've got people in a lot of these online companies that they see mortgage as a way to make a quick buck. They're really just a marketing company that sells mortgages. Okay, so they just want you to contact them. They're paying people very small amounts of money to push your loan through the system. But what that means to you is you're not getting advice. You're not getting the attention that you really need. You're not getting a personalized solution. You're getting a big box solution, a one size fits all. And unfortunately, one wrong decision when it comes to your mortgage can cost you tens or even hundreds of thousands of dollars. Even if it feels good, it may not be the right decision. So you need a local advisor because real estate is local. You want someone that knows the market, and you also need someone that has experience and has that piece of, helping hundreds or thousands of people. And unfortunately, if you want to get a job in mortgage, you're going to be thrown to the wolves if you tried to go out on your own and start your own mortgage company. But if you go to an online lender or one of these big box banks, they'll let pretty much anyone in. If you can fog a mirror and talk on the phone, crunch some numbers on a calculator, hey, you can be a mortgage loan officer. And it's unfortunate, but that's the way that it is now. And this is where a lot of people are getting their advice. And the reason is because they don't realize that there's a different way or a better way.
But when you go to the bank, especially with a bank that you have a relationship with, your personal banker, a lot of that is just a service that they will do gratuitously for their clients. You get paid, right? Of course you do. So are you an added expense? How do you get paid through all of this?
So I work for Benchmark Mortgage. We're a large mortgage banking firm. And yes, there's profit being made on mortgages. Like there is money, there's interest that you're paying as a consumer when you're paying a mortgage. That's profit to a bank or to a financial institution. That's how loan officers get compensated.
Oh, no. Like if I come in and I had a consultation with you.
There's no cost for that. So me personally, I don't charge any application fees. I don't charge any sort of advisement fees. I don't charge nothing like that at all. It's a 100% free, no cost, no obligation. Let's see what the numbers look like. Let's see if we can help you. And I'm glad you mentioned that because one of the biggest online lenders that I'm thinking of charges $500+ to come in the door as an application fee. And when you really look at why they do that, it's because they want you to feel tied to them. They don't want you to shop around. They don't want you to go find a local advisor that can give you better advice. Because what if you find someone that gives you a lower rate? What if you find someone that has lower fees? What if you find someone that gives you better advice? Well, then you're not going to deal with them. But if you just paid them $500, all of a sudden it's like, yeah, I'm just going to stick with them. And that's where they get you. So definitely want to stay away from that.
I'm glad I asked you that question. Let's go there. Let's go a little further there. What is maybe some of the top myths or misconceptions among homeowners looking to refinance their homes? I want to ask you another question, another thing about myths as well, but I'll get to that in a moment. I want to talk right now about homeowners looking to refinance their home. Any top myths or misconceptions?
Yeah, there's two that come to mind. I think the first one would be people go, oh, well, I've got a 3% rate or I've got a low rate already. I refinanced 6 months. I refinanced a year or two ago, and I don't need to do it again. I've got a low rate, and that's all they're looking at, and that's very short-sighted. They're leaving a lot of money on the table in a lot of cases, and again, they're just using that mentality that's been ingrained, by the banks, by the credit card companies, by the financial institutions, by their parents, etc., which is, again, pay off your mortgage as quickly as possible. Don't mess with it. You don't want it. So it's like, oh, I have a good rate. I don't need to refinance. Absolute not true. You need to look at your mortgage at least once a year. Absolute minimum. I don't care if rates are 10%. You need to look at the mortgage once a year.
How often can you refinance?
I mean, you could refinance as often as you want.
Once a year? I mean, come on.
You could. I mean, I have clients that have refinanced 5 times in the last 10 years. Okay, so every single time was a different strategy. Every single time had a different outcome. It had a different resolution that we were looking for. Okay, so you don't want to refinance every month. You don't want to refinance every 2 months. But at least once a year, look at your mortgage, look at your financial profile, get with a mortgage advisor, not just an online lender, to look at your overall financial picture, how much equity you have in your home, what your interest rates are, not only on your mortgage, but your other debt. What does your real estate portfolio look like? Do you own multiple properties? Do you want to own multiple properties? You might have the ability to turn your one house into 3 or 4 with the equity that's already sitting there. And if someone doesn't have the experience of being through this hundreds or thousands of times, they're going to not be able to give you the advice if they give you advice at all. So that's number one, is the interest rate myth. The other thing is, like we were talking about, how soon. So, people think that if I refinanced even a year or 2 ago, I shouldn't do it again. But there is no timeline. It's, can you benefit or not? I don't care when you last looked at your mortgage. Is there a benefit to redoing it again today? Whether you did it 6 months ago or 6 years ago, we got to look at it. The worst case scenario is we come back and say, no, it doesn't make sense to refinance. Your finances are optimal. Your mortgage is in a great spot. Keep doing what you're doing. And I tell people that every day. Like, that does happen. But you know what? A lot of people end up seeing all of a sudden a light at the end of the tunnel when you actually look at the whole picture to say, hey, wait a second here. I know you're paying 3.5 on a 30-year from a year ago, but I can do a 15 and your payment only goes up $50 a month. Doesn't that make sense? Invest $50 a month extra to pay your house off 14 years early.
Oh my goodness.
And these are the types of things people won't even know about if they don't get with an advisor. And I'm just using that as an example.
Right.
Might be 50, might be 100, might be 200. I see it every day. And right now, with the rates being so low, it's really common. Someone that took a mortgage a couple years ago at a decent rate can redo it now with a shorter term, lower rate, and not even really change their payment very much at all. So it's like this little move on the chessboard can put you ahead 5, 10, 15 years plus.
Maybe, how about some myths? This is the other part of the question I wanted to ask you. Maybe some myths or misconceptions among first-time home buyers.
So I would say, there's two camps of people when it comes to first-time home buyers. And you've got one group that think that you need a huge down payment. So they think, well, 20% down, my parents put 20% down, or my friend put 20% down. I thought that's what you needed. And they stop themselves from even looking at buying a home, and they don't really get excited about the opportunity to buy a home because they think it's out of their reach. I mean, 20% in today's economy is a lot of money in most areas. It's more than your average Joe or your 20-something may have sitting in the bank. So they think that there's this huge wall to get over. That's incorrect. You do not need 20% to buy a home, specifically to buy a primary home. But then the other camp of people is like the exact opposite. And I talk to these people every day, and it really, it pisses me off because they're like, oh, well, my brother's son's uncle's, cousin said he bought a house and he didn't put $1 into it. He didn't put any money down, didn't pay for closing, nothing. And I'm not saying that there's not a situation where the stars align and the seller pays your closing costs and you're a veteran, so you get a 0 down loan from the VA and all these pieces come together and you get a house with no money down. Like, that does happen, but I do hundreds of mortgages a year, and I see a scenario like that like 1 or 2 times a year, okay? Wow. So it's very rare. Like, you have to meet all these very strict criteria to get to that, but the truth is that it's somewhere in between. So for your primary home, specifically your first home that you buy, you're typically going to need anywhere between 3 and 5% down. So it's not nothing, but it's not 20% either. It's very feasible. It's realistic to be able to get into a house with 3 to 5% down. Yes, there's closing costs. Yes, there's other things that have to get paid, but it's a lot lower barrier to entry than people think that it is.
First of all, folks, you're listening to Mortgage Matters radio show with Rob Weinberg. I'm Gary Byron. But if you took on multiple mortgages, I think we were talking about this last week, where if you had $50,000, why put it all in one property? You could put it down on 2, maybe 2.5, meaning 2 properties and maybe a cottage somewhere, on a lake or wherever. Would a mortgage company ever say, oh, that's stretching you too much,
Absolutely, yes. This is not 2005 when you just fogged a mirror and got a mortgage. You have to have decent to good credit. Let's talk specifics. Right now, you're talking about 620 credit score is kind of minimum barrier to entry. Before COVID, it was a little lower, but yes, they've tightened up. But you don't have to have perfect credit. You can absolutely get a low money down mortgage with, like I said, low to mid 600 credit score. You do have to have a job. You do have to have income. If you're a business owner, there's going to be scrutiny of looking at your bank statements and looking at all these different pieces of the puzzle to make sure that you can repay that mortgage, because that was the issue that people had years ago, is that they were able to take a mortgage without proving that they could pay it back. Obviously, we know how all that ended in the foreclosure crisis.
Yeah, I remember.
So there is definitely very strict standards that need to be met. And sometimes it's going to be, hey, you can't get a house right now today. You need to wait, or you can only buy 2 properties. We can't get you approved for a third. But it all comes down to what we were saying a minute ago, having that mortgage advisor to not only look at today, but look 6 months out, a year out, 5 years out. Where do you want to be? How can this property, how can this mortgage play into your overall financial strategy?
I'm glad you mentioned COVID, because I wanted to ask you how COVID is affecting the real estate market here in Connecticut.
I think COVID is probably the best thing that ever happened to the Connecticut real estate market. I absolutely would say that, because, and I'm not someone that wants to be, downplaying something, but Connecticut had a horrible real estate market for a long, long time.
Sure.
Okay?
Yeah, we all know that.
When I started in real estate and in mortgage, Connecticut was booming. Okay. And I saw it go from booming to bust in literally a couple months. Okay. And it was very difficult to get mortgages. Home equity was going down. You couldn't give away a house if you wanted. You look at like 2008, 2009, It was very difficult to sell a house. It was definitely difficult to get a mortgage at that time. But with that said, we've seen that stay stagnant. Even though the economy has come back from that crisis, Connecticut really hadn't. The home values had been on a downtrend forever. You go back to that crisis and there wasn't areas where the properties were going up. It was stagnant to down. Then all of a sudden COVID hit. And people now wanted to move out of the cities. New York, Manhattan.
Right.
They don't want to be there. They're working from home. Why am I going to be there? I'm paying $3,000 a month in rent for an apartment. I can get a mortgage in Connecticut and be paying $2,000 a month for triple the size on an acre of land and all this. So Connecticut for a while was known as an area that people didn't want to move because of taxes and this and that. And all of a sudden, when COVID hit, people's priorities changed. And when their priorities changed, all of a sudden now, wait, that suburban lifestyle that lived 2 hours from the office that didn't work a year or 2 years ago, now it works today. Now it's the perfect storm. And now we've just seen this huge influx of people coming from New York. I'm sure there's other states and, that's always the case, but I have seen just an influx of people coming from all over New York, specifically the areas near Manhattan and near the city, Bronx and whatnot, and look at Connecticut as a very attractive alternative, to where they were before. Cheaper, even though our taxes may not be low, they're definitely lower than some other areas.
So there's a lot to look forward to this year.
Tons to look forward to.
For a home buyer.
Just a lot of opportunities, I think, that people need to look at. And, we haven't talked about interest rates that much, but that's, the big elephant in the room is that interest rates are very close to the historical lows. They're just off the historical lows right now. I mean, you're getting 30-year fixed rates in the 2% range. That's unheard of. 15-year fixed rates in the low to mid 2% range. Like, it's incredible to be able to see that. So if you're a homeowner, that's an opportunity you have to drop your expenses, drop your payment, liquidate equity, do all this stuff that we're going to be discussing in the future as well. And these strategies, you can do that now and take advantage. And then if you're a home buyer, you can actually buy a house now, $350,000, for example, at what it would have cost you for a much bigger house, before. So basically, because the rates are so low, you're getting a lower payment. So even though the home values have gone up, you may pay more, you're still getting a lower payment.
So what are you forecasting will happen with interest rates this year? Do you think they're going to remain at like that? You said about 2 for a 30-year mortgage and 2 in, maybe 2.5 for 15?
This is not going to last. We've already seen here in the first several weeks in 2021, the interest rates have come off the lows. They definitely have come off the lows. They're very close. In a stone's throw away, but they're not the lowest they've ever been in history today. You might have missed the boat on that, but they're so close. Take advantage now, take advantage today, because what I see happening is between, not to get political, but with the new administration, the stimulus, all the spending going on, inflation is going to run rampant. Yeah. When you look at what happens to mortgage rates in periods of inflation, it's the enemy of mortgages is inflation. So when inflation goes up, mortgage rates are going to go up. It's not a matter of if, it's a matter of when. So if you're a homeowner or home buyer, now is your time. Now is your chance to be able to actually move forward and actually be able to take advantage of the current situation. 6 months from now, a year from now, you may not have this chance.
Just curious, I got so many questions and I'm running out of time. I'm told I've got like less than 5 minutes. I wanted to talk about, buying or refinancing in 2021. And if, I don't know, maybe should I save that for next week? I got about 3 minutes. If you can give a quick answer to that, what should we know about buying or refinancing this year?
So buying, you want to buy as soon as you can. We're only seeing prices accelerate. And, there's no pressure, obviously. If you don't need to buy, you don't need to buy. Yeah. But I will tell you that now is the time because home prices are only forecasted to continue increasing. So if you buy today, a year or two from now, you should be sitting on some nice equity, some nice gains. Okay. Refinancers, homeowners, lock in a low rate now. We don't know what they're going to be 6 months or a year from now. We just know they're probably going to increase. Now's the time.
So, right, what are we talking about next week? We have about a minute and a half, so I wanted to maybe do a little teaser for next week.
Absolutely. I think next week, we've gotten a lot of feedback, and there's been strategies that I've discussed about debt consolidation, refinancing, pulling equity out of your home to consolidate debt. I also want to touch on pulling equity out of your home to invest in real estate or just use for whatever you want. Maybe it's putting an addition on your house, or putting, money into a mutual fund, or just all these places where this money is better used than in the walls of your house. We're going to go into strategies. I'm going to talk about case studies. I'm going to go into details on some specific clients that I've worked with that have used this to literally become very, very successful financially. Some of them have even become millionaires as a result of using these debt consolidation and cash out strategies.
Is it ever too late? Can you be too old for this, or can you really do this at any age?
There is no limitation. There's no age discrimination. I had someone the other day, 90-year-old woman, apply for a 30-year mortgage. And she was like, well, they're not going to give that to me. And that's incorrect. So I tell you that because it's never too late. The best time would have been last year, but the next best time is today. So let's do it.
I'm excited. I think there's so much ground to cover, and I liked when I heard from you. I love when I heard we're going to get into detail, because this is just a general overview that we did today. Even last week, we touched upon some things, but knowing that going forward, beginning next week, we can start to get into some details about some of these topics, and as well as take some questions from some of our listeners. Folks, if you have a question that you'd like to have answered right on this very radio show, it's very easy to get your question answered. Just simply email mortgagemattersradioshow@gmail.com. Again, I'll repeat that for you. mortgagemattersradioshow@gmail.com. Who knows? Even next week, we could get your question answered right here on this show, on these very airwaves. Now, if you got a personal question that you regarding this that you'd like to ask Rob, you can certainly do that. In fact, and I would encourage you to check out his website first and foremost. It may even be answered right within his website, or it may prompt other questions. You might as well get them all answered at the same time. You can email him directly from his website, which is robgw.com. Very easy. www.robgw.com. And of course, if you like to do it the old-fashioned way, it's kind of like me. I just pick up the phone and I call him, hey, Rob, I got a question for you. And he'll pick up. That's just the beauty of it. He's a personal guy right here in Connecticut. Love it. His phone number is 860-413-3938. Write this down. Let me tell you, what he's talking about could change your future. Put this right up on your refrigerator with a nice big magnet. Make sure it doesn't go anywhere. 860-413-3938. Wow. Can't wait till next week. For Rob Weinberg, I'm Gary Byron. Thank you so much for listening to Mortgage Matters Radio Show. Until next Saturday morning, have a good one, everybody. So long.